The times ahead will be radically different than what we've seen in our lifetime before. And how do we know that? Because they've always been the case ever since history. We firstly got to learn from the past. What has happened in recent times and what's about to happen haven't been experienced in our lifetime, but has happened generations before us. So it's just like a big cycle that repeats over and over again. The most powerful empire from 500 years ago were the Dutch, which went on to the British. Now with the US, and China might be taking the baton in the near future. In order to understand why economies rise and fall, or the world order right now, you need to understand how money or credit works. This is because money is the only thing people are inclined to fight over ever since generations. The main reason wealth rises and falls over time is because of credit. One problem facing most countries is it's often difficult for experts in politics and history to be simultaneously become experts in money, credit, economics, and even markets. To begin with, all individuals or countries have something we call revenue, which is what's coming in, and expenditure, which is what's going out. And if one's earning is more than one's spending, there would be leftover, which makes savings go up. But if one's spending is more than his earning, one must make up the difference by borrowing, which is called credit. The major driver of every economy is debt. But debt is not free. It's an asset to someone and a liability to another party. Let's take it on individual basis. Think of how much income you have relative to your expenses. How long can you survive when revenue ceases? And moreover, do you have a higher net worth? Large net worth means more assets, so you can spend above your income for a certain period of time. But if you have more liabilities, that means your expenses can't be more than your revenue, regardless of how much you earn. This is also the same in respect to businesses, institutions, associations, and even countries. But countries particularly have a bit of exception to this. This is they can produce their own money. Money printed all over the world by various governments don't have equal value. For example, a dollar produced in the United States is equal to approximately 6 cedis in the Ghanaian currency. There are certain currencies that are called reserve currencies, which means they are currencies that are widely accepted by people all around the world. These include the US dollar, pounds, euro, and many more. Countries with reserve currencies find it easier to do away with borrowed money. This is because regardless of how much debt they create, people, even in other countries, are willing to still have it for their spending. So they always create a lot of debt. So even at times like these, where there is shortage, they use that opportunity to print more and more. On the other hand, countries whose currencies are not reserve currencies don't have an equal opportunity to that. When they borrow money, they need to pay back in another country's currencies. So if Ghana borrows money, he needs to pay back in dollars. And also the borrowed money are usually used to make purchases in abroad. That's also in dollars. This depreciates our currency and therefore not favorable at our part at all. Moreover, let's ask, what is money? Money is something that can be used as a storehold of wealth and for purchases of goods and services. A storehold of wealth here means acquiring it and spending it. So the rich store their wealth in assets, which appreciates and keeps them more richer. Asset here means real estate, bonds, stocks, and even some other personal businesses. They don't store their wealth in even currencies they hold because it's a wrong investment. This is because money depreciates over time. So it's wrong to just store it for a long period of time without putting it to use. So if you want to store wealth or having it stored without having a risk of losing it, you can put it into investment like bonds, treasury bills, which the issuer gives you additional agreed percentage of interest after some time, which normally starts within 3 months. Or maybe you can put into hard assets like gold. So if credit is given to you, it's an asset to a party and a liability to another. Credits are just a matter of double entry. In the banking system, it's just created digitally, which is just a matter of typing it on the computer, which after some time it is given out to you. And when it is paid back, it's just cancelled out and disappears. But there is an additional money you pay in taking credit, which is interest. With that, it remains. This additional money is what goes to the bank as profit for the activity they undertook. So additional money is created out of credit as well as has boosted productivity to the borrower. With this, it has become a great asset to everybody entirely. But if the borrower used the borrowed money for just some liabilities, like say a big TV, there is no money which comes out of watching TV, and even it diminishes in value, and extra cash is paid as interest on it. This is a negative returns to the intrinsic value of things. The amount of money one has can be used as a measure of his wealth, but printing more money doesn't mean creating more wealth. More wealth comes with a result of more productivity. More credit increases spending, which boosts every economy, but it increases prices for goods and services. So if you buy something, maybe let's say a house, and the government creates more debt, the value of your house would go up, but yes, still it is the same house you will still own. That's why credit is just sometimes more an illusion than a reality for an economy. Think of debt as a source of negative earnings and a negative asset that heats up your earning, because your returns have to go to pay it, which eats up your other assets. Your other assets which you could own or you already have to be sold to pay debts. So when one income falls and his other assets are sold to clear off his debts, and if that's not enough, then a debt restructuring takes place, which becomes problematic to both the lender and the borrower. Another problem which arises from this is holders of debt assets, particularly bonds, don't get adequate returns from it. Bonds are storeholders of wealth which will be sold out later. During this time, holders of these debt assets find it difficult to make conversion to real money. When this happens, investors or holders of these debt assets all at once suddenly sell off their bonds, which leads to a bank run. And since bonds have inverse relationship to interest rates, when the cost of borrowing money rises or interest rate rises, bonds prices fall, and it's vice versa. So at this point of time, regardless whether the bank is a central bank or a private bank, is then placed in a dilemma, either to allow the flow of money out of the debt assets, which would keep interest rates rising too fast, and that becomes troublesome to the borrower, which causes debt and economic problems to worsen. Or they have to print money to buy those bonds, which the investors are selling, to prevent the interest rate from rising. The bank, both private and central banks, can do these works temporarily and then reverse it back, which can enhance successful run of the economy. But this sometimes doesn't work out successfully, especially when the holders of these debt assets are extremely large. So if the ratio of demand for money or from debt assets to the amount of money they can produce or have it in reserve is extremely large, the bank simply can't get enough money to buy those bonds. So it would automatically default on its works. And if it's solely the central bank, they can continue to print money, but it will devalue their currency. And when currency devaluation and debt restructuring are large, it destroys the monetary system of a country. Private bank, on the other hand, can only continue to operate in this situation if the government intervenes or bail them out. In this situation, central banks have more options than private banks, which they can print more money or change the laws of the states to make it favorable to them. And if it is not, maybe in some other reserve currencies which some countries practice, then they would have to default. Always take note, money is what pays bills, but debt, on the other hand, is a promise to deliver money.